your screen and you can start the presentation. I've now hit the record button and we're anxious to see what you have. And you need to unmute yourself. Steve, you're muted.
That always helps.
All right,
Should
there
I
you
unmute?
Also,
Jump off that first 5 seconds there.
Remind everybody that you can put questions into the chat box. We're going to try to monitor that and make sure that we get all your questions answered. Sorry,
Okay.
Steve.
All right, everybody. Good evening. My name's Steve Estel. I live up in the North Denver area. I'll talk a little bit about my background and how I got to where I got to. As Vern mentioned, we've known each other for 4+ years. I recognize a lot of the people on here. I'm also working with various folks up and down the Front Range, such as Mitch Conrad, John Wells, and Jerry Minnie. I think a lot of you who are in the Denver area know those folks. So today we're going to talk about cash flow and how it relates to taxes and property ownership and all those sorts of things. Got quite a bit of material here. Can everybody see my screen okay? Somebody give me a thumbs up. There we go. Good, Vern. Thank you. All right. Let's see if I can get this going here. All right, I'm kind of a quote geek. This one's a little bit long. I actually ran across it today. So this will be a test, all you historians. I'll pause for a moment and let you read it over. I'll give you a hint. This wasn't any recent quote. So anybody know the author of this quote? Want to take a guess?
Teddy Roosevelt.
Anybody else? There you go. Give that guy an ice cream cone, okay? So, you know, we're dealing with some pretty uncertain times, so I thought this was kind of, you know, applicable. And where we are today, this is probably something that I don't know the exact timing of when he did this quote, but I suspect back in the 20s and 30s and stuff. So, all of you are at different points in your assisted living evolution. Some of you are highly experienced. Some of you are just starting out. So I like this to basically say we're all at different points. And so the strategies I'm going to touch upon today, some are going to be applicable to your particular situation. Some aren't. Some might be things you just file in the back of your brain and say, well, I'll come back to that in a couple of years and see if it might assist. Or, you know, maybe you know some people that might be able to use this. So a little bit about myself. This is personal stuff. So I am a native Texan. I grew up in the North Dallas area, went to school there all through my under years, had allergies for 20 some odd years out in Dallas. And if anybody's been in Texas, you know, things don't, they just don't die. You know, the trees and the flowers, they don't go away. So I just decided I wanted to get out of Texas after college, which was a computer science degree. Went to work for IBM. I don't know if you recognize the slide in the upper right. That's the Watson, when Watson went up against the champions in Jeopardy. Of course, IBM developed Watson. I wasn't directly involved in that, but a lot of people don't know what IBM does. If you want to know what IBM does, talk to me offline. I ended up spending 34 years with the company. Left that in 2016 and got into what I'm doing today. The picture in the lower left is a trip me and my wife, who's in the last picture, that's Laura, that we went on back in February, actually right before COVID. And this is an island off the coast of Africa called Madeira. If you want to know more about Madeira, it's just drop dead gorgeous. I'm going to work with Vern and we're going to open an ALR over in Madeira, and that's where I'm going to retire. So, and then to the lower right, this is my family. That's a little bit of a dated picture. I have two young adult boys, and then my daughter in red, that's Rachel. She lives in Brooklyn, New York, but she's actually visiting right now. She's a fashion designer. And then my other two sons are still here in the Denver area. And then my wife in the middle, that's Laura. We'll be going on 34 years of marriage in September. And she has her own business as well. She has an Etsy storefront. If you want to learn more about that, we'll talk about that offline. So I heard we might have some tax professionals in the house, and this is by no way to denigrate them. They have their niche and their place, but what we're going to talk about is kind of how we intersect with tax professionals. Anybody know how many pages the tax code is? Any of y'all geeks like that? No tax geeks? You say about 75,000 pages. I think Forbes did an article not too long ago. So it is supposedly, I don't know for sure. If any of you CPAs or tax professionals have a more accurate number, let me know. That's what Forbes said. And then we're going to talk about the activities that a tax professional typically performs. Now, each one's going to be a little bit different, has their different niches, but we're going to delve into that. Okay, keep moving. All right. My little animations didn't work very good. I like this little cartoon to the left. I don't know how recent that is, but we're probably going to be heading in both directions, would you say, in the not too distant future. So what does a tax professional do? They're typically gathering documents. They're maybe linking into some sort of accounting system. They might be doing accounting themselves. They might be doing some payroll. Just depends on the nature of the tax office and all the different services they offer. They take that information, translate it into the IRS forms accurately. A lot of times they're importing data if they can get it electronically. Helping the client with deductions, maybe quarterly payments, maybe they're keeping in compliance. And then of course, they want to ensure accurate and timely filing. They want to make sure that you don't file too late. If you're going to file past the deadline, you get extensions. Deal with any federal and or state related situations. And then they collect their fees. They could be collecting their fees throughout the year or one time, and then next year they repeat the process. In general, tax professionals are recorders of history. And again, this isn't meant to put down any of the people in the tax world, but they're typically ill-equipped to proactively mitigate tax liabilities. And that's what we do. So what's our role in Stride? Stride is the organization I'm linked up with. We basically work hand in hand with a tax professional, and we provide information to them. We provide information to the client. And by working together, we can, in some cases, completely eliminate clients' tax liability backwards, today, and going forward. And that's what we're going to spend the brunt of this presentation talking about. Got some other topics I'm going to talk about as well, but that's what a lot of it's going to be. So let's talk about specialized tax incentives. What are specialized tax incentives? So they're very specialized strategies to mitigate tax liabilities. Specialized being the key word. They require specialized and in some cases proprietary skill sets, technology, and services. Some of the stuff I'm going to be talking about here is proprietary to our particular firm. Some of it's other firms can get into the same business. Certainly what the IRS and the code all spells out. You know, anybody can get into that business, but we've spent almost 20 years developing some of our strategies that we're going to talk about. And as I said, we work in tandem with the tax professional. We partner with them. It's really, we want to be in lockstep with that tax professional and helping the client mitigate as much of their tax liability as possible. So let's go a little deeper. So the first thing I'm going to talk about, because a lot of people aren't familiar with this, is what's the difference between a tax deduction and a tax credit. Some of you might know this, and I know this is a little bit rudimentary, but some of you maybe have never delved into tax credits. And I'm going to explain what the difference is between the two. So tax deductions. Basically, in a nutshell, tax deductions offset your taxable income to lower the effective tax liability and put you into the appropriate tax brackets. Simple example, we'll just use 25% as a tax rate. That's pretty conservative. If you got $1 million in revenue, you get 600,000 in deductions. You end up with a 400K adjusted gross income. If you apply the 25% tax rate to it, you owe 100,000. So what's a tax credit? Let's take the same similar example. Tax credit reduces dollar for dollar your income tax liability. So same example, million revenue, same deductions. You have a 400K adjusted gross income, 100K taxable liability. If you have $100,000 in tax credits, you basically negate your liability dollar for dollar. So let's go into some tax strategies. So the first one I'm going to talk about is hiring incentive tax credits. So this is a program for employers that hire people or have people on payroll. It's not new. This is something that's actually been around since World War II. In essence, it's a tax credit to incent employers who would like to hire from certain disadvantaged target groups. And it's not only disadvantaged, it's certain target groups that the government would like to give a leg up, such as veterans, okay? And we'll talk about the different target groups on the next slide. It's designed to increase employment opportunities and really mitigate every time a business owner or a hiring manager hires somebody, they're taking a risk. And this is designed to mitigate that risk to the business owner, as well as incent them to hire from certain disadvantaged target groups. You can get as much as $9,600 in tax credit per qualified hire. The average is more around $2,400, but the max is upwards of $9,600. It's a time-sensitive system. So what do I mean by that? What I mean is once that person goes on the payroll, if you haven't done certain activities, then you've forfeited your eligibility for the tax credit. So this system that we're going to describe in more detail is designed to be used as you're interviewing candidates, you're vetting the candidates, you're deciding, maybe you've got one opening and you might go through 10 different people interviewing and screening and maybe background checking before you determine who's that final candidate that you're going to hire. And as I said, this is not new. It was introduced after World War II. It was designed to incent businesses to hire veterans after World War II. And since then, it has morphed over, now we're talking 75 years now. And it now includes a number of different categories of workers. So who qualifies? I already mentioned veterans. So veterans, depending on their particular situation, can qualify $2,400 upwards of $9,600. Long-term family assistance. I'll talk about what TANF is here in a second. Some of you might know, but I know it's a goofy acronym, and we'll delve more into that. SNAP, which is food stamp recipients, long-term unemployed, SSI recipients, disabled workers can also qualify. Enterprise zones, which are certain areas of the country that are in, let's just call it disadvantaged economic situations that each state deems as areas they want to incent more hiring in. Vocational rehab, ex-felons, and summer youth, and there's a few others that aren't, but that's the brunt of them. TANF stands for Temporary Assistance for Needy Families. And then in 2019, the latest statistics, there was over 2 million tax credits divvied out by the states across the country, because the states certify these tax credits, which equates to over $5 billion in benefits that were approved by the states. Each state operates independently. Our particular system works in all 50 states. So it doesn't matter if you're in Colorado or Hawaii or Ohio, Texas, Arizona. So we can handle any of the 50 states. So our particular system, there are some other ones out there, but ours is proprietary. We've built it over 20 years. It's all software-based, electronic-based. It allows unlimited applicant screening before the hiring decision is made. It includes a confidentiality component to it. If I have time at the end of this, I'm going to demo how the system actually works. And then depending on how the client decides to use the system, they really can significantly influence the outcome and the percentage of candidates that can qualify. It's very simple to set up. I've literally had this set up. I was meeting with the CPA about 6 months or so ago before COVID down in his office in South Denver. He was about ready to hire somebody, and we were going to talk about referrals. And by the time I left his office, we had this system up and running right there in his office. We have a toll-free phone and direct chat support with our back office team. There's really no risk in using the system. It literally pays for itself if you get a single tax credit. There's a monthly subscription fee, and we can talk about, you know, the overall fee structures offline, but it's literally that simple. All of our tax services include full audit protection. So if the client's ever audited, we produce all the paperwork, step in, work with the tax professional and the client. We've really never had anything overturned. So we stand behind everything we do. And as I said, we're nationwide. Your typical qualification rate with our system are going to range pretty widely, depending on locale and how intensely you use the system, but anywhere from 10 to 50% qualifications is not unusual. So here's just and I just happen to have this. This is a assisted living facility. This is a testimonial from our back office. This was a client that hired a large number of employees. I don't know the exact number per year. They already had a system in place to try and get tax credits. They were getting about a 3% qualification rate. Our people worked with this particular assisted living facility. They switched over to our system. And in the first month of switching, they had over 60,000, I'm sorry, not 60,000, excuse me, 60% qualification rate on their candidates. And this is basically what the client had to say. Thank you for showing how easy it is to capture this tax credit. It will have a monumental impact on how we do business. So Vern, why don't I pause there and see if this system might be new to a lot of people. So I'm not looking at the chat. So are there questions or anything?
Not yet. Does anybody have any questions you want to plug into the chat window?
Okay.
Kind of quiet.
I'm going to move on then. So the second strategy, and I know, Vern, you had a recent speaker that delved into a lot of detail on this, is cost segregation. And since there's been some prior review of this strategy, I'm going to kind of hit the high points and touch upon some things that I think are really important and move on to some other strategies. But if you own facilities and you are not using cost segregation or you haven't looked into it, it's a tremendous opportunity. And with the CARES Act, it opened the door to some really unique strategies to use. So what's cost segregation in a nutshell? It's an engineering study on a piece of commercial or multifamily real estate. It runs the gamut of apartment complexes to strip malls to also, just drive up and down your particular area of the country, and just about every commercial building you pass has the potential to be used with cost segregation. And of course, in the assisted living, these are in essence multifamily units. They can qualify as well. In a nutshell, accelerated depreciation or cost segregation, which is the IRS term, it shortens the overall depreciable life on a property structure. So a standard multifamily piece of real estate is typically, from an accounting perspective and a CPA perspective, is going to be depreciated over 27.5 years. So all the elements on top of the land can't be accelerated, but everything on top of the land, parking lots, roofing, flooring, excuse me, electrical components, cabling, just a variety of different elements of maybe landscaping, those sorts of things. they all have the potential to be put into a shorter depreciable life. So, oftentimes, and every property is going to be different, but sometimes you can see 10, 20, 30% of the overall value of the property reclassified. In some cases, we're looking at very recently purchased property or constructed property. Some cases, we're looking at property that was purchased 5, 10, upwards of 20 years ago that still can generate enough benefit to make it worth the strategy. So when do you use this? This can be used on purchased property, constructed property. We can do what if scenarios and say, oh, if you bought this piece of land and you built X amount, maybe working with your architect, what's the potential benefit? Sometimes we can work with the broker involved in the deal. We can use it on renovations. We can use it on demolitions. If you're going to buy a property and completely demolish the existing unit on the property or units, you have the opportunity to potentially do a cost seg before you destroy that property and get some value out of it. And then we can also use it as part of transactions. We can use it as an incentive for a buyer and those sorts of things. So we can get really creative with this stuff. TCJA. TCJA is the Tax Cut and Jobs Act that was passed in 2017, sometimes known as the Trump reform. So there was this thing called bonus depreciation that was improved upon in that reform. And then with the recent CARES Act, they've added additional things that can make it even more beneficial. Even if you have leased property, in some cases, if you've done significant leasehold improvements on the property, you potentially still can use cost segregation. So it's not just ownership. It can, in some cases, apply to leasehold operators as well. And then, like I said, unprecedented look-back opportunities. I'll touch more upon that in the next slide. And most of the time, the people I'm talking to, they're just not using the strategy. We talk to business owners and property owners across the country. There's a lot of people that don't know about this, or they don't know how to properly apply it to their particular situation, or maybe they're just trying to do it on their own and they're not getting the maximum benefit out of doing this.
Steve, would you have a question?
Okay.
What's the average price for completing a cost segregation for an ALR?
I mean, it's going to range. We look at it at a project by project basis, but most of the ones that I've worked on range anywhere from $4,000 to $6,000. But it really depends on the particular project. What we do is a free feasibility analysis, and all we need is some basic numbers on the property. And we can typically do a feasibility analysis, and once we have the depreciation schedule, we can do those typically within 5 business days, and then come back to the property owner and say, okay, here's the potential benefits, and discuss in more detail what the full detailed study and the pricing on what that would look like. But we're not going to spend our time if we don't think there's significant benefit, and obviously vice versa on the client side. So there's some fixed costs in our studies that are just built in, with the engineers and stuff like that. But in the $4,000 to $6,000 range is kind of, I'd say, kind of a sweet spot, but it's going to vary. And then last but not least, and I'm not going to talk in any detail, we have a property tax mitigation service as well. So clients out there who are paying significant amounts in property taxes, we can assist in that realm as well, nationwide. So I'm going to do one last slide on cost seg, and then I'm going to move on. But this chart here really, in a nutshell, it shows the benefit of cost segregation. So if you look at the red line, and this is a commercial property. Commercial properties are typically straight line depreciated over 39 years. You basically take the land valuation, separate the land valuation from the everything else on the property, you know, the structures, the parking lot, etc. And then you typically straight line depreciate that. That's what most accountants, most CPAs are going to do. With cost seg, in this particular case, the cost segregation was performed in year 2 of the property. They get a large increase in their depreciation, and then it starts to tail off. Okay, so it's all about net present value, and the thought that $1 today is worth more than $1 tomorrow. And then, of course, as time goes on, then you're going to drop below the straight line depreciation. So with the Trump reform legislation, there were some changes made in 2017 that basically said, if you do cost segregation, you can take depreciation in the year that you did the study, and then what you don't need, you can defer up to 20 years. So that's the way everything worked up until this year. This year with the CARES Act, you now can go backwards in time. So for instance, if somebody on here just filed their 2019 taxes with their tax professional and they owed money in 2019, they still have the opportunity to go back, do a cost segregation. They'd have to amend the return or amend their depreciation schedule. And if they also had liabilities going back into 18, 17, 16, as far back as 2014, they can go back and amend those returns and get prior year's liabilities refunded to them from the IRS. I'm not an accountant, I'm not a CPA. I just know the strategy exists. It's perfectly legal after the CARES Act. So we work in tandem with your accountant and your CPA to see if that's viable for your particular case.
So Steve, I have another question.
Okay.
What about recapture of the depreciation upon sale?
Yeah.
What's that look like?
So there's a lot of, I'm not going to get into the nitty gritty detail, but really the net is there is a recapture component once on sale. But typically, and we can delve into the specifics in any particular situation, but typically if the client's going to hold their property at least 2 years, and that was the rule of thumb even prior to the CARES Act, I think the holding period could be even less given the look back capabilities. But you know, if you're going to hold it at least 2 years, and depending on price point and some of those sorts of things, you're usually going to be able to get benefit that's going to far outweigh the recapture cost. And certainly if you're going to hold it for 3, 4, 5 plus years, then absolutely it's a great strategy. If you are getting ready to sell a property, this can be used, as I mentioned in the prior foil. It can be, I'm dating myself, I'm saying foils. I did actually do foils at one point in my career. This can actually be used as a selling incentive to the buyers. So we can do what if scenarios. We can do a feasibility analysis that says, oh, you want to sell this property for 700,000. What's this going to look like for the potential buyer? What the fees might be to do the study, and it can be packaged into the overall transaction to provide some value add on the sale of the property.
Thanks.
Okay, so we can talk more about cost segregation offline or in the Q&A. So I'm going to delve into some other strategies. So this is called the Employee Retention Tax Credit. This is brand new in 2020 with the CARES Act. So enacted back in March of this year. It's a payroll-based tax credit. For clients that can qualify for this, and there's a lot of ifs, ands, or buts, but if you do qualify, you can get upwards of $5,000 in tax credit per retained employees. It's currently targeted for employers with impacted revenues and/or mandatory shutdowns during the pandemic, which obviously is still ongoing. If you qualify, it can offset your payroll taxes. So you're like your quarterly FICA, Social Security, those sorts of things. Currently, the current legislation says if you took PPP, you are likely disqualified from using this, but there's a lot of current legislation still out there to be written and finalized, and the word on the street, in fact, I have a meeting on Friday, is that there's a good chance they're going to open the door to employers being able to use PPP in tandem with the tax credit. Don't quote me on that. That's all hypothetical, but that's kind of the rumor on the street back in Washington. And as I mentioned, it's very fluid legislation. I mean, all this tax code's getting written, it seems like on a daily basis, but our people are staying on top of it. So if you want to explore it in more detail, we can delve into your particular situation. Okay, the next tax credit, disaster retention tax credit. And this is a new service of ours, but it's not new. Out there in the marketplace, it really doesn't have anything to do with the CARES Act. We've just launched it in the past month or so. So across the country, because we are a nationwide company, there are selected states and counties that can qualify for disaster retention tax credit benefits. You can, if you qualify, you can be eligible for upwards of $2,400 tax credit per employees retained during that particular disaster. And when I talk about disasters, I'm not talking about pandemics. That's a disaster in and of itself. I'm talking about floods. I'm talking about fires. I'm talking about hurricanes. Tornadoes, maybe. All sorts of different things across the country. The client has had 2018 and/or 2019 operations. Again, this is a payroll-based tax credit, can offset your payroll taxes. Like I said, it's not new, and it can be used in tandem with other tax credit programs. So it can be used in tandem with our hiring incentive program. It could be used in tandem with the employee retention tax credit. These all can be cumulative tax credits that can be, in essence, stacked on top of each other. So where's the disaster tax credit eligibility applicable? Every state here in green has particular counties in those states that are eligible. So you'll see Texas, you can see up and down kind of the southeast corridor, a lot of the hurricane states, those sorts of things. I'll just mention a couple of counties that are worth noting. In California, if you have operations in LA County, you can qualify for this potentially. If you're in Texas and you're in Harris County, which is Houston, Texas, you can qualify for this. So anybody who's in one of those states, and again, I'm not going to get into all the intricacies of every different county, but we can talk offline whether your particular, there's Ohio. I know we've got a guy on here that has, or he's out of Ohio, and I think he said he had a number of properties in Missouri. So, so we could delve into that. Okay, so I'm going to take a quick break and kind of get a time. How am I doing on time, Vern?
You are spot on right now.
Well, I've still got more stuff to go. So any particular questions? Anything coming in there, Vern?
Nope, nothing yet. No more questions at this point.
Okay. All right, we're going to delve into succession planning. I think I got about maybe 10 minutes max more of information, and then we'll open it up for full Q&A. So we do succession planning, and we'll delve more into that at a super high level, okay? So basically what we do is we do an assessment on behalf of the client, and we figure out, well, let's talk about why you need to do exit planning. And those out there have been business owners and have sold businesses. I think you can attest to this, but some of those folks on the call or out there have never done this before. And in general, most underestimate the importance of exit planning. Okay, it's like an estate plan for your business. There's a lot of elements to it. In general, we've never found a former owner who said, I just overplanned this. It just doesn't exist. This, in essence, could be the most important activity of an owner's life. It's bigger than buying your first home. It's super important. And with baby boomers and the current demographics, there are a lot of businesses that are going to be going up for sale. A lot of business going up to sale because of the pandemic. And if you don't plan this out right, you're not going to maximize what you can get out of that exit plan. If you own commercial or multifamily or equipment, maybe you have some property tax liabilities. So what we do is a questionnaire. So we have a questionnaire, literally this questionnaire is sent electronically. The client has about 40 questions they answer, takes about 15 minutes. And through that questionnaire and the software behind the scenes, it generates a 12-page report. And it basically grades the client on different areas. So the 4 areas that it focuses in on are finance, planning, revenue profit, and operations. So it gives basically grading assessments on each of those different areas. And then from there, we go into a full-born consulting with the client and say, okay, let's talk about your particular situation, your priorities, and how do we start developing a roadmap to get you from where you are today and where you might want to be in 2 years or 5 years or, you know, even longer time periods. How does it keep doing that? Okay. If you want to learn more about exit planning, get with me offline. We can talk more in details on that. That could be a whole session in and of itself. Now I'm going to talk briefly about pitfalls of traditional retirement plans. So people like me who worked in the corporate world for 30 plus years, let's just say I ate, drank, and slept a 401k. And all these points to the right are equally applicable to IRAs or SEPs, or, there's a whole slew of different what are called qualified retirement plans. But 401ks are typically the most well-known. So I'll just use that. But as I said, it could apply to a large IRA or something along those lines. So 401ks, if you're a business owner, you have a lot of things you got to take care of. And when you set the 401k up, oftentimes it's like, oh, darn, I didn't know I had to do all this other stuff. So you got testing requirements. You got the SEC that might come in and audit you on a periodic basis. You got contribution restrictions. The IRS and the ERISA guidelines say, I don't care that you're 57 years old and you want to put $100,000 into your 401k. You can't do it. The restrictions limit your contributions. They have discrimination rules, which means if you're a business owner and you have a 401k, you got to match up with all the rank and file employees, and you got to make sure you don't get any favoritism over what the employees in the organization get. You have ownership rules that you got to deal with. If you have a 401k and you want to tap into it before you're, say, 55 or, as far as even age 60, you can have early distribution penalties, which can be quite onerous. RMDs, or required minimum distributions, these typically happen later, maybe age 70 and higher. But at that point, you're required to start pulling money out of them, and you're going to get taxed on it. Fool's wager, I don't have time to go into that. It's just time's not going to permit it. But let's just say everybody knows what a 401k is in general, but it's a wager that a lot of people, myself included, put a lot of money into. And on the back end, it's not going to bear out what you hoped it would do. You do get a front end tax benefit. So the money you put into it, you get to defer taxes and you get to defer the growth, which are all good points. Those are good points. Our particular program, which is called SRP, or the Stride Retirement Program, they have no testing requirements. We do not have contribution restrictions. You can put $100,000 into the program if you qualify. You don't have discrimination rules. You don't have ownership rules. There are no early distribution penalties. I mean, I talked to, I don't know, in this day and age, I got millennials and stuff, and they say, "Hey, Steve, I want to retire when I'm 40." Maybe they're 30 now. Well, you can do that sort of stuff. You don't have required minimum distributions. The fool's wager, which I'm not going to go into, it doesn't apply here. Tax benefits is a question mark, but in general, after we've talked to the tax professional for the client, which we do as part of our program, it usually is yes, you do get front-end tax benefits. And you also get tax for deferred growth, just like you would in a qualified plan or a 401k. The big differences with our program and traditional retirement programs is the last three. Tax-free distributions. This is a huge one. The end of your 401k, when you start tapping into it at age 60, 65, 70, or beyond, every dollar you pull out, you're going to get taxed. That's just the way the program works. And you're just going to have to bite the bullet no matter what age you are and pay those ordinary income taxes. Market loss protection. If you're in a 401k, you're in typically mutual funds. You're in an S&P 500. You're in, I don't know, maybe a bond fund, you know, all those different traditional Wall Street programs. And you don't have any downside protection if the market corrects 5%, 10%. What did we have earlier this year? I think a 20, 25% correction in the market back in the March timeframe. You don't have any downside protection, and you can't do leverage in a 401k. You put $1 in, that's what gets invested. Maybe you've got some matching by your employer, but in general, leverage doesn't apply. In our particular program, you can do tax-free distributions. You have market loss protection. So if the market goes down 10, 20, 30%, our program can return you 0, 1, 2%, depending on the particular situation. And you can use leverage on this as well. So let me summarize real quick. So who are we? Our name is Stride. We've been in business for 20 years. We're a national real estate and business consulting practice. I work with business owners all over the country. Our focus is enhancing cash flow and profitability. We have a variety of different services. I didn't even cover all the ones that we do. Typically, we're tapping into unrealized benefits for the client. We work on a no-risk contingency basis. What does that mean? If we can't save you money, there is no fee. We've saved clients over $4 billion over the last 20 years. As I mentioned, all of our programs that are in the tax space, we have guaranteed audit protection. We have our own proprietary technology that makes engagement with myself and our team very seamless. Typically in 30 minutes or less, we can run you through a benefit qualification and figure out which services might be a good fit for your situation and estimated savings. And then, as I mentioned, the proprietary retirement exit program. And then we also, and I put this for last, but it's important to note, we can build alliances with tax professionals, with commercial real estate brokers. So there's a variety of different strategies that are beyond the scope of this call. But if you want to delve into what that looks like, see me offline. And then this is a full list of all of our different services. I've covered a large number of them, but I haven't. On the expense side, I didn't cover any of those. We have a telemedicine company. So if you're looking for a benefit, potentially for your employees, we can talk about that. Very cost effective. And we also have a corporate financing arm. All right. I don't know that I have time to do the demo. Let me pause there just for the sake of time, and it's a good break point. Questions that might have came in, Vern?
Let's see here. So when hiring, how do you determine if someone is taking SNAP, TANF without violating the law and asking their personal information?
Great question. So I mentioned in the one slide, we have a confidentiality element to our software. So in essence, the way our system works is the WOTC survey is built inside our software. The client adds the candidate name, email address. We have 2 different languages. We can send the survey in. We can send it in Spanish or English. The survey gets sent electronically to the candidate. When they open that survey up, it says at the top, it says, the answers to these questions could affect your eligibility for your employment. So that statement is in there. It also has a question at the end that says, it's a legalese question that says, you are signing off here saying that the answers to all these questions are true and factual. So that covers the client and our people from a factuality perspective. And as I mentioned, the final certification for the tax credit is handled by the state. But our people have databases behind the scenes that do cross-checking and various things. But at the end of the day, it is an honor system. But you know, the candidate says, I signed in legalese that these answers were accurate and factual. So I don't know that, you know, I'm not a lawyer, but I think that protects both the employer as well as our people should any suit come about relative to this.
Okay, is there any other questions you guys want to ask? Steve, I think we'll go ahead and wrap up the meeting, but leave it open. And if
Okay.
you want to view the demo once we wrap it up, that'll be, you know, just part of our leftover
Okay.
networking we can do.
Sounds good.
Thank you so much for the presentation. That was great information. A lot of great info that I hadn't thought of on some of that stuff. That's good stuff. And we'd like to put the slides up on the website along with this video. So when you have an opportunity, if you could shoot those over to me, if that's all right.
You want the PowerPoint or you prefer it in PDF?
PowerPoint, we just convert them to JPEGs and put them out that way.
Okay.
So that would be fine. Or PDF would do the same thing. Okay. I'm going to grab the screen again.
Let me stop sharing.
And we now have our haves and wants part of our program here. So this is an opportunity for anybody in the audience. If you are looking for partners, if you have a service you want to announce, you can take a minute and tell everybody what it is that you are looking for. Sebastian just gave a round of applause to Steve. So yeah, anybody else that wants to do a round of applause, and we can show him our appreciation. And I can't do my icon, so here's my thanks. Okay, do we have any haves and wants? Please raise your hand.
Actually, I'll go first. Vern, I'm a sponsor for RALNA, and I want to invite everybody to a webinar tomorrow night. The registration link is in the chat, and it's tinyurl.com/WTP RALNA. And it's going to be introducing 2 German medical devices, which are basically going to change the entire industry. The first one basically is FDA cleared for healthy aging and recovery of muscle injury. The second one is the one that's huge. It's been cleared for pain, both acute and chronic, including arthritis pain, naturally through frequency. And we're going to be introducing this to assisted livings. And they've both been cleared a month ago. They're German medical devices, but GSK Pharma, who is the 9th largest pharmaceutical company in the world, last year said working with a person's electrical system is the medicine of the future. And these two devices they've invested $715 million to research it. And these two devices are way ahead of them. So I'd like to, number one, invite you to a webinar. And two, if you have a facility here in Colorado, I would like to come and demonstrate it. My contact information is on chat. This is going to completely separate your facility from all the rest.
All right, Les, thank you very much. Sebastian.
Yes, thank you, Vern. And also thank you to Steve. That was a great presentation. So shout out to Steve. I have 2 condos in Thornton I'm looking to sell. I just don't have, I have a lot on my plate right now and I don't have the bandwidth to take them on as flips and to do the BRRRR method. So if anyone is interested in taking those on, you know, let me know. It's just 5,000 earnest money for each, selling for 146 per. And there's a small discount if you buy both of them at once. And so we'll be showing that tomorrow morning, also Friday afternoon. So just let me know, and I put my contact information in the chat. So thank you.
Thanks, Sebastian. Again, I want to remind everybody to put your contact information in the chat, and you can also save that file. We'll leave the program open for a little bit this evening so that you can go in and save that file. Jessica, you're up.
Hi, Jessica Laney, Colorado Springs, and unfortunately I still wanted to be able to come into this thing and be able to watch the whole event, and I've only been able to get in for the last 5 minutes. Like I don't know, for some reason, like it just fell off the screen. Anyway, glad to be here for at least the last couple of minutes, but I wanted to kind of thank y'all from last time, and I was able to gather a lot of great information and talk with the presenters from last time. And I was able to figure out a way to be able to actually be able to make my assisted living facility down in Colorado Springs work, because, you know, the person that was next door to me, you know, within 500 feet, I was able to figure out a way. Thank you, Michelle. I was able to figure out a way to be able to basically make it work, which is to be able to classify it as handicapped and disabled facility versus a assisted living residence. So yeah, so now kind of moving forward with it, and now going through trying to read the entire FGI guidelines and all the other applicable codes and all that kind of stuff to be able to figure out what needs to be done. And then eventually look for an investor to be able to assist with all the different modifications that need to happen. So anybody that's interested in kind of a first-time person who is extremely excited about doing something like this and wants to get involved, I am happy to you know, talk to anybody or possibly partner with somebody or do whatever it is to be able to kind of move forward with this. So anyway, just super excited and glad I was at least able to catch the last couple of minutes of this and say hello to everybody.
Thanks, Jessica. That's great news, what you've just given us. Makes me feel good for what we're doing here and creating an opportunity for people to network and actually have some success in this business. We did record this, so we will be putting it up on the website once we get everything prepared. And that way you can go back and review it. Anybody else want to have a have and want? Michelle.
Hey, this is a public service announcement. I know that I've said it before. You guys have probably seen it on the Facebook page and whatnot. But speaking of Jessica gave me a great segue. Speaking of the FGI guidelines, these are the 2018 FGI guidelines that Colorado has adopted. So on the FGI's website now, I'm on the drafting committee for the 2022 guidelines. The draft is up for public comment. All of you guys from Colorado know that the 2018 guidelines, we've really been struggling with this because they're not particularly friendly for the small ALRs. They're designed for big facilities. So we got some changes in our regulations made, but I really tried to make some changes in the next iteration. But it's like a building code. So it's iteration. So as people use these guidelines, then you need to comment on the next version so that needed changes can be made. So Colorado really is the first state that adopted this for small facilities. The only other states that have adopted it for facilities are Connecticut, and they really don't have small ALRs. Tennessee, but they have some provisos so that it doesn't apply to small ALRs as much. Nebraska just adopted it, and Arizona just adopted it for 11+, which means that those of us in Colorado are the ones that have the most knowledge of them and most ability to comment on it, to make needed changes. And, you know, I did what I could on the drafting committee, but guys, I'm a lawyer and I know a lot of architects and engineers, but I'm really not one, and not a contractor either. So I would really encourage you to go online, look at the 2022 draft, especially chapter 4.1 that applies to assisted living, and chapter 2, which is stuff like acoustics and lighting. And I just couldn't comment on that. So if you want changes made to the next version, because Colorado will stick with this. I just had a meeting with the health department this week. Colorado is really committed to FGI. So please, please comment on this. Don't be mad at me if I missed something and nobody else got in there to comment, just because, like I said, I don't know if I got everything. So please contribute if you can. Thank you.
Thank you, Michelle. We certainly appreciate your hard work on that for the community. Mitch.
Hi there. I just wanted to let everyone know, if anyone knows of an ALR that they're looking to sell, we're looking to continue to acquire. We're up to 8 homes and we're closing on number 9 next month. And then I've also got a buyer that wants to get into Denver with a skilled nursing facility. So if anybody knows of a skilled nursing facility in the Denver area, let me know. I put my information in the chat.
All right. Super, Mitch. Congratulations also. Anybody else? All right. Well, I'm just going to wrap up here. So our website, I didn't get the right one up here. It is daalr.com. We do have yearly memberships, 80 for an individual, 120 for partners. And we do have room for some vendor sponsorships if you are a vendor. And coming soon, eventually, we'll be back at Torchy's Tacos, meeting live. And we don't know when that's going to be. So I don't think it's going to be real soon. I'd like to thank everybody for coming. Make sure that you print out the chat box. I'm going to leave this open. Steve's going to do a demo on his software. So you're welcome to hang out and watch that demo. And please make sure you have your contact information in the little chat box right there. And I'd like to thank everybody for attending. And we're thrilled that we're getting some people from out of state that are attending as well. Hopefully we brought some value to you. So everybody have a great evening, and we'll see you next month, unless you need to chat with me beforehand, and my contact information is in there. Thanks, everyone.
Thanks, Vern.
Thank you, Vern.
Okay, for the folks who are hanging around, let me blow that up. So this is our hiring incentive program. This is what it looks like. This is the system that I said, you know, the client is hiring, I don't know, tomorrow or early next week. I mean, this system can be set up very easily. I know it looks kind of intimidating, but it's not. Once the client has done some basic setup, then they can literally go over here and start screening their candidates for potential eligibility for tax credits. So they literally click on that button, says add a candidate. They've created some locations, some different positions. Let's just say housekeeper. And Les, since I know you, I'm going to pick on you. Since you're, so I'm interviewing Les. And Les, what's your address? What's your email?
Les520@earthlink.net.
520
Yeah, that's the easy one.
at earthlink.net. That look right?
Yep.
Okay, the phone number is completely optional. That's not required. And then this is the 2 different languages that we can screen the candidates, either in English or Spanish. Unless I really want to make Les mad. Do you want me to send it in Spanish, Les?
That might be interesting.
Yeah. And literally that's how quickly you can enter a candidate. I click here. This is a demo system. Les now is going to get an email. And I'll go over to, so here's Les. He's being interviewed as a housekeeper. Sent the survey to him on July 30th. And then you can see down here where it says incomplete. So Les literally should have received the survey through his email. Once he has that, he can click on a link that brings up the survey questions, and all the answers to those questions are kept confidential. Les knows them, certainly our back office team knows them, but the business owner does not get visibility to the answers to those questions, and that's by design to promote honesty, as well as, you know, ensuring that they're revealing all the potential for a tax credit. If they have eligibility because they're an ex-con or because they were unemployed, these are things you're probably not going to ask people because they're kind of taboo in the hiring world. But because we keep everything confidential, we just expose the tax credit. So once Les fills out that questionnaire, then it's going to look something like this for Scott Troutwine, which says it's been completed, and then it's going to have a number next to it. And that number is going to represent if there's any eligibility for a tax credit. If there is, the business owner or the hiring manager, you can delegate and provide other people access to the system, and the decision's made to hire somebody that's eligible. Then they go in here, they click the hire button, complete their hourly wage and start date. As long as all that's done before they go onto the payroll, then our back office will take over from there. It goes into the employee section, and then we handle all the filing of the paperwork with the state to certify eligibility for the tax credit. And then once that's complete, then we provide all the necessary documentation for the client to use it to offset their tax liability. That's really the nuts and bolts of the system. Like I said, it's really easy to set up. I'll just log out and kind of show you. This is the login screen. We have a support button, so if client gets stuck with something, they can immediately access our support team. Not 7/24, it's Monday through Friday, but they are there. There's an 800 number they can call in. They've got myself to help as well. I don't know if the chat mechanism's still working, but any questions? If you want to unmute yourself, you can ask questions. Let's see, trying to navigate over the chat. Oh, I guess I can't see the chat while I'm sharing my screen. Anybody see any questions in the chat? Okay. All right, the last thing I'm gonna demo, and I'll keep this brief because I know we're right at the top of the hour, get people out of here on time. So this is, I talked about the employee or the disaster retention tax credit. And I talked about all those different states that have the potential eligibility depending on county. So this is a website where client can come on here, say, how many employees do you hire annually? They can go in and complete the questions. And once they go far enough answering the questions, oops, dang it. Then it's going to go search for eligibility for different tax credits. The first one will be the hiring incentive program. Then the next one's going to ask some questions about COVID, whether the business operations were suspended or not. There's a yes or no. Did they have any significant revenue loss? Comparing 2019 versus 2020, say second quarter. Whether they own commercial real estate. Then eventually it gets down to these questions. And so these are all the states where the disaster retention tax credits can be applied. So let's say, I don't know where everybody is, but maybe there's somebody in California. I mentioned here's Los Angeles County. So if you had an ALR in Los Angeles County, you could have tax credits that you might qualify for if you had operations in 2018 or 2019. Or maybe you're in Florida. There's a list of counties in Florida. Let's pick something a little closer to home. Nebraska. There's a list of counties in Nebraska. Now, don't ask me what cities these all cover because I don't recognize them. I have actually a farm in Iowa, and there's the states in Iowa. I recall one gentleman on the call, I think he had a number of them in Missouri. So there's all the counties in Missouri. So anyways, I'm not gonna keep going on. I think you get the picture, but if your assisted living residences are in one of those counties, you potentially have tax credits you can qualify for. We can talk about the details offline, but if you don't go after them, then in essence, you're just leaving money on the table. So questions, because we're right at 9 o'clock from anybody? Everybody had enough for one night? Enough financial gobbledygook, huh? All right, Vern, I don't know if you're still out there, but I am gonna wrap up if you wanna stop the recording, or maybe you already did, I don't know. And stop the share. Okay. Well, I'm going to wish everybody a good evening. Thank you so much for your time and listening. If you'd like to talk more, please reach out to me. I think I put all my information in the chat. Have a great evening, and thanks again.